Hey traders, this is Christian from Hertz Tropica Trade Group, and this is your end of day, end of week video for Friday, January 21st. And I mean, kind of at this point, glad that the week's over. Short week, only 4 days, but certainly felt like a full, much more than even a full week with the volatility this week. Really fast moving markets, and yeah, the weekend just couldn't come fast enough. It just didn't look like the price action was going to get any better for the day. I'll summarize that, and we'll just kind of go over some more just things that we're kind of noticing in the market. I was on Bloomberg TV earlier, just talking about a couple quick observations. It's always, when I'm on Bloomberg, it's like a quick 2-minute segment, so you can't really talk that much in detail about things. So let's get to that. Theme of the day, I don't know. I just put kind of just carnage, after what we saw in Netflix after hours, and there just wasn't really much appetite for any on much on the long side. A couple of things that you've heard me talk about the last couple of days is where is sentiment, and where are some things, some indicators under the hood. What are they indicating? Are they indicating that we're close to the end of the sell-off or not? The word that came to mind that I've mentioned a couple of times is complacency, right? We have not seen a real big pickup in the equity put call ratio. I went over that in yesterday's video, so I'm not going to go over it here. We'll see what the data comes out. Hopefully that's indicating that there's not so much complacency anymore in the market. I would think after a day like that the number would tick higher, but what we've seen so far is kind of just the longs not getting involved in this market in terms of institutions. And I think part of that has to do with just, I don't want to say the overall uncertainty in the market, because there's always uncertainty in the market, but the fact that there's a Fed meeting next week and no one really knows what they're going to do. It could be that I think that there's some whispers out there that they could actually raise rates in the meeting and possibly do 50 basis points. So at this point, so would that shock the market even more? Anything is possible, but I think just getting this out of the way and hearing from Powell, I think when you have these events that are upcoming, sometimes funds just are basically not wanting to get involved in the market, and they're kind of a deer in the headlights. That's what it kind of felt like a little bit today, and there's just there's a lot of funds that have been really long and they're liquidating. And that's been now going on for most of 2022, and I think part of last year too. Some of what the price action reminded me of some days that we saw in the last week of 2021. Just price cannot rally. There's no push on, and no bouncing of things. The market just doesn't have that momentum at all to kind of push it to the upside. The only time I think that we move up a little bit is short covering. Right, we saw that a bit towards, and if you remember last Friday's video that I put out, which was ahead of a 3-day weekend, I said, hey, we might actually see this market come up a little bit because of short covering. The shorts don't want to have big positions, as well as the longs don't want to have big positions into a 3-day weekend. Just typical things that we see from time to time. A couple other things just to kind of note. We'll kind of just talk about this S&P chart here for just a second, but now you've got this waterfall down basically. So I wanted to just talk about a little bit of strategy and what we're dealing with on a daily basis. It's a reminder that when we're looking at levels, and I believe I touched upon this in yesterday's video, that there are certainly levels to watch where things could potentially change, right? Where we could see what's called the change in momentum, right? And I look for levels like that all the time. We've seen these types of corrections or market moves to the downside before. This one is pretty dramatic, right? In terms of how fast this move has been to the downside, and just looking at that chart. But I would remind you that one of the things that we've been going over the last couple of days is, like, hey, the 200-day moving average could be something where the S&P stops at. We said that, I think it was a few days ago with the Qs, right? But if you do not see a change in momentum, and I got some, I guess that was yesterday. Sorry, sometimes these days kind of blend together. But if you do not see a change in momentum at that level, right? And basically what that means, because I had some traders ask me, well, what is that? What are you using an indicator to spot a change in momentum? No, it's just the price action, right? The price action is the most important thing, right? Under the hood indicators and looking at things like the put call ratio and looking at sentiment gauges, they're important too, to kind of pick up on some hints. But the most important thing is to watch the price. And if there isn't, if an important level is not being defended and you don't see a bounce at an important level, and that's kind of what I mean by, bounce or even the price respecting that level, right? That would be a change in the momentum. If you just see price slice through your support level, then you know that you've got a bigger then we've got a bigger correction on hand, or a bigger market dip, or just more pain to the downside, right? And what I wanted to remind everybody in this video is that we cannot control any of this. We could look and we can monitor. And and that's something that you heard me say in a couple of these videos at the end of the day. I think that was actually the theme that I mentioned 2 days ago, is that you just kind of have to watch and wait for some of these things to say, okay, well, geez, it wasn't the 200-day moving average. Well, where is price going to go next? Well, could it be logical that it was this virgin point of control takeout? Hey, we didn't even, we breezed past this. So that's not it. So none of these places are to say, oh, when we get to this, I'm going to deploy a whole bunch of money. That's not how it works. It's, hey, when we get to this level, I'm going to watch and see if that level is supported. And if we start to see some things if we start to see a change in tone, again, I say change in momentum, but that's kind of the same thing. And if it doesn't, then you got to just continue to kind of, sit on your hands and just monitor, right? Because again, reminder that none of us can predict these markets, right? And predict where the price is going to go. What we can do is monitor and say, okay, this is a logical place for price to stop and reverse. And again, that momentum to change. But if it's, sometimes the market is not logical, right? I mean, and this is hindsight 2020 stuff, but we've had a huge run the last couple of years. And what's made it so difficult, I think, when you're dealing with this type of market meltdown that we're seeing right now, is that we've been conditioned over the last couple of years, right? As if you've been bullish or if you've been in that camp, that every dip that we've seen eventually kind of gets bought. Even if you're wrong in the beginning, eventually this market has bailed you out. That has worked, and I don't know what percent, but I'll just make something up, maybe 90% of the time over the last couple of years. But eventually there are bigger corrections. It is just how the market works. And I've traded through a bunch of these, and you do lose your muscle memory because, when we don't have them for a long time, then you you forget, a little bit of what of how what you should be watching and how it should work. But yeah, it's tough to basically abandon that philosophy of like, oh, I'm going to buy the dip, right? Because it has worked so many times. And if you didn't do it over the last couple of years, you had to pay for it because the market would come back up and everybody was buying the dip, and it would, it just became routine. So the point of what I was saying here, or what I wanted to say, was that the market will go wherever it wants to go. And clearly, hindsight 2020, this trend has lasted for a long time, right? This bull market has lasted for a long time. So when it does come undone, which it kind of feels like it's coming undone now, the best thing, in my opinion, unless you're really aggressively playing things down to the short side, is to just get out of the way. If you're looking at this point to deploy some equity, it's hey, let's wait for a change in tone, right? And I know from being, from doing this for a long time and being in the seat of someone who didn't have the experience, you always think that you're going to miss out, You always think that like, oh geez, if I don't like figure this out right now, I'm gonna miss the big rally, you know. And if you've seen these types of moves to the downside, and this is where that muscle memory comes in, you realize that this game is not about trying to pick where the bottom is in the market, or where this market is going to turn. What you will find with experience is just waiting for it and realizing that the market will it will do what it wants to do, and we can't control what it's going to do. And the more that you can sit it out and say, hey, I'm going to watch for things. And even if you get caught, yeah, you have to realize no one is perfect, right? Even if you dip your toe in and try a trade and it immediately doesn't hold, not immediately doesn't hold, but if it doesn't hold, you got, in my opinion, what I do is I bail on the trade, right? So SMH is something that I'm watching too, the semis. Right. Here, of course, big break of value. This is not what I wanted to see. I came into the week looking for longs and semis, and that actually hurt me quite a bit. Right. And that's just how it works. This stuff was really, really, one of the one of the trickiest setups that I've seen in a long time. UCTT was probably, and I wasn't alone in this. I think a lot of people were looking at this and saying, hey, potential breakout here. You got this huge green bar that happened, right? And then look at what it did the following day. And this happened also in a few other ones, Applied Materials, Lam Research, right? But it is what it is. You have to realize that, hey, that trade entry, that thought, hey, the market changed what it wanted to do. And again, it comes to the old saying is like, hey, you're going to be wrong. You're going to, especially when the market has been this tricky, you're going to be wrong a lot. You just have to kind of not stay wrong, because when you stay wrong and stay stubborn, it could really compound the issue. And again, I'm not saying I'm perfect in it and have done played this month well at all. It's been one of the trickiest months, I think. When you see things like this. Here's the chart of Applied Materials. So the reason why I'm kind of going over some of these things, I mean, that's how tricky is that, to see this thing break out just about a week ago and break down like this. So again, extremely tricky market. I would say too, like, do not beat yourself up over these things. It happens in markets. It's called, there's a phrase for when things get really difficult and you catch the market the wrong way, you're susceptible to a drawdown, right? So these things happen. It happens to the best traders out there, so don't let anybody try to tell you otherwise. It happens in markets. Drawdowns do happen. Markets can get more difficult at certain times. And yeah, the best thing that I could say is if you're staying out of the way of it a bit, rather than trying to predict or worrying or thinking that you're going to have FOMO if you don't catch the exact level. And it's tough. It's tough because, there's a lot of, we're also, a lot of us are on Twitter and so forth. And, there's a lot of characters on Twitter that will try to continuously create that FOMO. And it's not easy. So you think, hey, am I missing something? Someone's thinking that, hey, this is the bottom is in or whatever. Here's my trade blotter for the day. You could see I really didn't do much once. I wanted to talk about just a quick other observation. But here, like, having to get out of RRC, which worked really well for me. I think I hit 3 targets in that trade. Took that trade off, right? So every day, kind of, it's been unwinding of, a position here or there. And I tried a couple trades, and I wasn't super greedy with them. Hey, I was hoping, and let's go to the 5-minute bar, right? In the S&P. Right. So like another, what I like to refer to as shake and bake, right? Beginning of the day, right? Market weakness. We turned around, which has been kind of different, different type of market action today. We turned around at 10:20, right? So you're thinking, hey, now we've got a little momentum, wind on our backs, right? And then all of a sudden, basically at an hour later, that was the end of that. And this has been the pattern that, you know, while this pattern wasn't exactly the same in the time of this move, but the pattern has been that any bounces just not only do not sustain, but just get wiped out. And what I was trying to explain in the trading room today is that, hey, when you watch some of these I'm on the 5-minute chart, right? So we're looking, each bar is 5 minutes. But when you watch some of these things, you know, we were kind of for a while flirting with, you know, and I mentioned that watch as we kind of retrace in here. What normal action would be when the market has some strength to it is you kind of come in here and you retest, and then you kind of maybe build and then break back out. But what I noticed, and I've seen this in other pullbacks, is many of these bars, and it was even more, I think, prevalent when you look at the NASDAQ. And it's tough because I can't show this to you right this second, but many of these bars started green in the first couple minutes of the 5-minute bar, and then the last 3 minutes, it would be faded. So by the time the bar closed, you had what was green was a red bar. Whenever you see that, right, the sellers are in control of this market. Right. And that's why I kind of I gave up for the day, which is, again, not what I want to be doing. I want to be trading. Right. And it's the hardest thing to be like, hey, this is not looking right. Right. So, and I pointed this out in the room probably somewhere around this time, around 12 o'clock. I said, hey, look at these 5-minute bars. They keep the first couple of minutes as green. And then by the time they close, it's red. The sellers are still in control of this market, even down here was my words of what I said. And then once, you know, clearly, you know, I said, I didn't make very much money on this whole thing from yesterday. That was even a much greater move than today was. You know, I know everybody seems to think that option expiration was going to be like the biggest event. Yesterday was a bigger event at the end of the day. But in any event, I won't dwell on that because it was not a quadruple witching today. It's just a monthly option expiration. And I understand that there was more, I guess, you know, more positions, you know, more deep in the money type stuff that had some gamma effects to it. But, you know, so what I did then, you know, once we kind of broke this range, and I probably was a little bit late on it, but just put some puts on. All right, so this is at 229. You know, the first kind of break of this range, and it, again, was at the end of this bar. I said, hey, if we're gonna do something like this, which again, we didn't have as dramatic of a move, I got to be in there to kind of you know, profit from that. And I basically said I would try to hold on to those puts throughout the session. I took 2 targets, and then you could see I didn't unwind them to the very end of the day. All right. So, you know, the main, you know, the question that everybody's going to be asking themselves, and we'll get the equity put call ratio number out later. And the only reason why that's important to me is because I want to see if there's some panic that that is finally in this market, because it can be a psychological factor. And sometimes once there's finally some panic in the market, that's sometimes when the market can turn. But yeah, I mean, I'm not going to go over any major levels here because how can you? You know, when you close like this on the lows, there's nothing to really kind of hang your hat on and say, oh, geez, I think that this is going to turn. Just have to kind of wait to see what Monday's market action brings. And again, remember, we've got a Fed meeting on Wednesday, which is really going to be a pivotal, you know, or could be pivotal market action in the middle of the week. All right, guys, I'll leave it there. Did I go over the performance did I skip that? No, here's the performance for the week. And by the way, this is the last 5 days. That's just how Bloomberg gives the data. But oh, this should not be in green. I don't know why that's in green. Maybe because I had to put something in green or something. But the only thing that was in green was, I guess, was gold. Right. Ethereum, Bitcoin, big moves to the downside. Ethereum down 21%. You can't hide in growth and value, right? You know, that also got hit. For the week, the only thing that was really positive was the gold miners and Chinese internet names. I'm going to mention one more concept before I end this for the weekend and relax a little bit, which I think everybody should be doing. But if you look at EM SPY, be careful with these ratio charts, right? So you could see EM is really outperforming. When the market is correcting, like it is, and moving to the downside, a ratio chart, to really profit from this, when you're looking at EM over SPY, you have to be long one and short the other. Why is that? Because you could have a potential lot of different outcomes when you're looking at this ratio chart. So I see these ratio charts used all the time, and I honestly don't think people really understand that if you're going to profit with them, you have to be long one and short the other if you're exploiting a relationship. The reason why is because there's 4 different outcomes. I think there's 4 different outcomes, right? EM and SPY could both. So for this to happen, right, where EM is going up versus SPY, it could be emerging markets, and so EEM and SPY both go up, but EM goes up more. It could be, or maybe it's just 3. It could be EEM goes up and SPY goes down, right? So EM, like this week, was up, or no, so no, that's the third outcome, is that they could both go down, but EM could fall less than SPY, right? So the only way that you could extract this outperformance is if you're long EM and short SPY for the week, right? Because your short profited more than your long. So if you're just thinking like, oh, I'm going to exploit this by going long EM, when this happens, and this can happen quite frequently, is that they both go down, but the one goes down less than the other, and therefore it outperforms. So be mindful of that, because you're going to see a lot of these charts, and that's sometimes when people throw something that's very volatile and not something very volatile. The only way to exploit that performance, take advantage of it, is if you go long one and short the other. All right, guys, that's it for this week, for this video. Have a great weekend, everybody, and I'll see you guys back on Monday. Of course, if you're a member, you'll hear from me over the weekend.